Hello, everybody, and welcome to today's webinar on 1031 Exchange Basics. My name is Jeff Stechmann. I'm the Florida Business Development Director for Asset Exchange Company. And before we kind of dive into the topic, just kind of want to let y'all know, after today's webinar, you will receive a link with the recording of today's webinar, audio and video. So don't feel like you have to write every single thing down. And also, I'll mention this at the end, a lot of what we're going to talk about today, I have in PDF form. I'd be glad to email those PDFs out to you guys if you are interested, especially if you have clients that possibly have 1031 exchange needs. It'll be something really simple. You could forward it on to them. And then the other aspect about questions for today, I'll open the floor to questions at the very end because I find in most cases, if you do have a question, a lot of times it'll be answered in an upcoming slide. But again, if we don't cover your question, feel free at the end to ask the questions. There's a little box on the right-hand side of your screen that says questions. Right there is where you would actually want to type in any questions you may have. So I know we had a few people that just joined us a little late, so I'll introduce myself again. Again, my name is Jeff Stechmann, Florida Business Development Director for Asset Exchange Company. To kind of give you guys some information about myself, I've actually been in the business for 24 years. I did a lot on the title side of the business to get my start. I did just about everything there is to do on title. I owned my own title agency at one time. I actually have lived in Florida for 21 years out of the 24 years that I've been in the business. So I cover the entire state of Florida, but pretty much anything throughout the eastern United States. You'll see in just a few minutes with 1031, you're not limited in the law doesn't change from state to state because it's a federal code. I'm originally from New Orleans, so if you guys hear the accent come through, please forgive me. Every now and then it rears its ugly head, but and I was just there this last week for Thanksgiving, so I'm still trying to shake it off. But I'm glad to say that I'm a survivor of the real estate industry because boy, I've seen the really bad times and I've seen the really good times too. And, you know, hopefully we never see those bad times again for those of y'all that are or have been in the real estate industry as long as I have. So let's go ahead and just dive in, right? Well, to kind of give y'all some information about the company, we've actually been in business since 2006. And over the course of our existence, we've done about 30,000 1031 exchanges. You know, it's all that we do. We don't provide any type of closing services. We don't manage properties. We don't provide any type of financial services. Our main, people refer to as a qualified intermediary, QI for short. Now, you may hear some other terms that people refer to as an accommodator. Another term is a facilitator, or just simply an intermediary. But in our part of the country, people just call us QIs for short. Now, our main job in a 1031 exchange is we hold what we refer to as the proceeds from the relinquished property. So the relinquished property is the property being sold in a 1031 exchange. We hold those proceeds from that sale on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they would lose their ability to do a 1031 exchange. And we're going to talk about that in more details in just a few minutes. Now, excuse me, a word of caution about QIs. You know, it's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So what exactly does that mean, right? Well, what that means is anybody out there can be a qualified intermediary. There's no guidelines that you have to have any type of E&O insurance. There's no guidelines that you have to be bonded. There's no guidelines on where you hold the proceeds, the type of funds you hold those proceeds in. It's a really scary thought when you sit down and think about it. So if any of you guys on the line are currently involved with the 1031 exchange, just make sure you do your due diligence and you're dealing with a reputable company, all right? Great news when you deal with us, right? Well, we're actually based out of California. San Francisco is our home office. And because we're based out of California, the state of California actually has what they refer to as the California Franchise Tax Board. Now, that state agency, that Franchise Tax Board, they actually oversee qualified intermediaries in the state of California. We're subject to audit by that Franchise Tax Board. They do require us to carry minimums for the E&O insurance we have, the bond that we have. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in. That's all overseen by that Franchise Tax Board, which is great for anybody that deals with us in California. But then anything that we do nationwide, because we do 1031 exchanges all over the country in multiple states, well, that Franchise Tax Board has oversight in anything that we do. Because as I mentioned, they could come into our office in a moment's notice and audit any of our files, not just California property, anything that we do, any file that we do anywhere in the United States. So great news when you deal with us. As far as our ownership goes, we're actually owned by two gentlemen, and they've been in the 1031 exchange business specifically for 20 plus years, one of which is actually a tax attorney. His name is Adam Skarsgård, and Adam is actually considered a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The reason I like to bring Adam's name up is because something that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, we would actually provide free audit support. We would work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney, Adam Skarsgård. So just another benefit when you deal with us. Now let's talk a little bit about the history of exchanging. You know, believe it or not, exchanging has been around for close to 100 years. It really started back in the 20s with farmers, and the way it worked back in those days was, you know, maybe I had a farm that I grew corn, and I had another farmer that I knew that he had a farm that he grew wheat, and maybe I wanted his farm and he wanted my farm. So all we did is just swap farms, and it was really that simple back in those days. But our modern day exchanges, kind of the form that we follow today, well, that was really started back in 1979. And there was a gentleman by the name of T.J. Starker. He lived in California, and he owned all this land in California with timber on it. And what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is, in exchange for the land, well, they gave him what was referred to as exchange credits. And what Mr. Starker did with those exchange credits is, over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. Now, if any of y'all on the line have ever heard of the term a Starker exchange, well, that's where it comes from. It comes from T.J. Starker's last name. I still talk to some people today, you know, some CPAs or investors that they've been in the business for, I don't know, 30 or 40 years, and they still refer to a 1031 exchange as a Starker exchange. So that's where the name comes from, T.J. Starker. So let's talk a little bit about the code. So, you know, when we talk about 1031 tax deferred exchange, well, the name is actually derived from Internal Revenue Code section 1031. And the code states this: no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. All right, I know that's a mouthful, right? It's a lot to digest. Well, let's take a look at the part of the code where it says property held for productive use in a trade or business. So you can do a 1031 exchange on real property that you use in your trade or business, right? So I'll give you guys an example. Last year we did an exchange for a gentleman that owned a daycare center. All right, so he was using that real property for his trade or business, right? Well, he did a 1031 exchange with us, deferred his taxes, and we're going to talk about that in just a few minutes. And what did he do? What did he buy as a replacement property? Well, he went out and bought another daycare center because he was going to use that real property for his trade or business. All right. Now, the next part of the code where it says for investment. So, for investment may be something as simple as, let's say you own a single-family residential home that you hold it for investment. How do you hold it for investment? Well, it's a rental property. All right. So you can take that rental property, sell that rental property in a 1031 exchange, defer your taxes, and then what can you buy as a replacement? Well, that's the next part of the code, like-kind property. All right, so what exactly is like-kind property? Well, like-kind property is any type of real property that you use in your trade or business or that you hold for investment, and you can exchange it for any other type of real property that you use in your trade or business or that you hold for investment. Okay, so just because you have that single family residential home that you hold for investment, right? That rental property. Well, it doesn't mean that when you sell that in the 1031 exchange, you have to replace it with another single family residential home. You can do that by all means, all right? But you could also replace it with a duplex or fourplex, vacant land, a commercial warehouse, a commercial strip shopping center, a downtown commercial office building in Tampa, Florida, okay? Any type of real property. As long as what you're selling property that you use in your trade or business or you hold for investment, and as long as what you're replacing it with is property that you use in your trade or business or that you hold for investment, okay? And that property or those properties can be anywhere domestically located in the continental United States or even the U.S. Virgin Islands or Guam, okay? Puerto Rico is not included in that number. All right, Puerto Rico, I think they're under a different tax structure. That's why it's not included, all right? So let's talk a little bit about current tax rates. So when you sell real property, if you have any gain in the property, you're going to be subject to capital gains taxes, right? Right now, capital gains taxes are going to either be 15% or 20%, all right? The 15% is applied when, if you're single and you have income of less than $400,000 a year, or if you're married and you have income of less than $450,000 a year. That's where the 15% kicks in. Now, the 20% kicks in if you're single and you have income of greater than $400,000 a year, or if you're married, you have income of greater than $450,000 a year. That's where you'd be at the 20% capital gains tax rate. So again, you'd be subject to the capital gains tax rate, right? Either 15 or 20%. You'd also be subject to what they refer to as depreciation recapture tax. Now that's an additional 25% tax. Now what exactly is all that about, right? Well, the depreciation recapture tax is any depreciation that you've claimed on the property, the entire depreciation for the entire time that you've owned it, when you go to sell that property, you're going to be hit with a 25% tax just on the depreciation alone, okay? Now, on top of that, you may also be subject to what they refer to as the Medicare tax, all right? That's an additional 3.8% tax. What is all of that about, right? Well, the Medicare tax, that was passed back in 2010 with the Affordable Care Act, Obamacare. It went into effect in 2013, all right? It was one of the things that they passed to try to offset some of the costs of the Affordable Care Act, all right? So when you do a 1031 exchange, all of these taxes you can defer, right? You can avoid having to pay any of these taxes. Now, what am I not listing up there? Well, I'm not listing state income tax, all right? For those of y'all on the line that are located in Florida, well, we don't need to worry about that, right? Because we don't have state income tax. But if we live in a state that has state income tax, or even if we are selling property in a state that has state income tax, we would also be subject to state income tax, all right? When you do a 1031 exchange, you can also avoid having to pay any state income taxes, all right? Now, each state kind of has their own way of doing it, of you going about getting the exemption. I'll give you an example. Last year, we did an exchange for a gentleman. He was a Florida resident. He was selling California property, all right? Now, California has some of the highest state income taxes in the entire country. I think it can be up to as high as like 13.3 or 13.8%. What California requires that you do is you have to complete this form, right? This state form for the state of California. You have to complete it and send it in to the state, and that's how you get the exemption from the state income taxes. But you have to complete that form every year thereafter. The year you don't complete that form, they come after you for the taxes, all right? We did another exchange for a lady. She's a Florida resident as well. She was selling some property, I believe it was in Maryland. Now, what Maryland requires you do, there's another form that they require you complete. I think they require you to complete it like 21 days prior to closing. We had to actually sign off on it as the qualified intermediary, and that's the way you go about getting out of having to pay these state income taxes for Maryland. So, every state kind of has their own way of doing it, but I guess the good news is when you do a 1031 exchange, you can avoid having to pay any federal taxes that are due, the ones listed on the screen, and also state income taxes as well. All right. Now, let's talk about this, because I get this question all the time. People will ask me, they say, well, Jeff, how long do I need to hold a property for it to be considered investment? And, the honest answer is, I don't know, because there's nowhere in the code that states how long you need to hold the property for it to be considered investment, right? It just states that you need to use the property in your trade or business, or you need to hold it for investment. Now, if you ask some CPAs, they'll tell you a good rule of thumb is, you need to really hold on to it probably for about a year, for 12 months. And if you think about the logic about that just for a minute, let's say I buy property today, all right? I buy an investment property today, and I'm going to hold it for a year, right, for 12 months. Well, I'm going to claim it on my 2019 taxes as investment property, and I'm also going to claim it on my 2020 taxes as investment property, all right? So is that a good rule of thumb? Well, maybe, all right? Is that a good holding period? Maybe. Some other CPAs, they'll tell you, well, you know what? You really need to hold it for 24 months. That's a good rule of thumb. And one of the reasonings behind that, we're going to talk about it in the very next slide, but back in 2008, the IRS came out with guidelines regarding vacation homes, all right? And in those guidelines for vacation homes, they stated that in order for a vacation home to be considered investment property, you must hold on to the property for a minimum of 24 months, for 2 years, all right? So some CPAs pick up on that, and they say, well, for vacation homes, the IRS is giving us guidelines that for a vacation home to be considered investment property, you must hold on to it for 24 months. Therefore, any type of investment property need to hold on to it for 24 months for it to be considered investment. But the reality of it is, it's not so much about how long you hold on to the property, how long you own it. It's more so about your intent. Like, did you advertise the property for rent? Did you advertise it for fair market value rent? If fair market value rent is $1,500 a month and you're advertising it for $5,000 a month, well, you know what? The IRS may have an issue with that, right? Did you show it to potential renters? If you get audited and the IRS comes in and says, hey, prove to us that you held that property for investment, you have to be able to back it up, all right? I list one particular court case on the screen there on the slide. It's referred to as Resnick versus the commissioner. In that particular court case, the circumstances was you had a husband and wife. They owned a single-family residential home, a primary. That was their primary residence. They also owned another single-family residential home that was an investment property, all right, a rental property. So what they did is they sold that investment property, that rental property, in a 1031 exchange, deferred their taxes, and the replacement property that they bought was another single-family residential home, all right? That was going to be the investment property, the new rental property. Now, 6 months after they did their exchange, all right, during that 6-month period, they ran a classified ad advertising the property for rent at fair market value. They even showed it to 2 potential renters, all right? But for whatever reason, I don't know the circumstances, but for whatever reason, they could never get the property rented out, all right? Now, what else happened during that 6-month period is one of them loses their job, right? Now, they had a mortgage on their primary, okay? They also had a mortgage on the investment property that wasn't rented out. So what they did was they sold their primary residence and they moved into the investment property, right? After 8 months of ownership, they moved into the investment property. In that particular court case, it was ruled that their intent for the investment property was to hold it for investment, all right? But what happened? Their circumstances changed, right? And they had to do something. So again, it's not just about the time frame of how long you own the property. It's more so about your intent. And again, you're going to have to be able to back it up in case you get audited, all right? So investment intent. Now let's talk a little bit about vacation homes, all right? I always like to bring up vacation homes. I talk about vacation homes, especially for those of y'all that live in Florida, because here in Florida, you know, everybody wants a vacation home or everybody has a vacation home, right? All right. So how does that vacation home qualify as an investment property? All right. So this is actually referred to as Revenue Procedure 2008-16. All right. And the first requirement we already talked about, you must own the property for a minimum of 24 months, all right? Now, for every 12-month period of ownership, you must rent the property out at fair market value for a minimum of 14 days, okay? Now, you can use it for some personal use, all right? So for every 12-month period of ownership, you can use it for 14 days personal use or 10% of the total time it was rented. So what exactly does that mean, right? Well, let's just say during that 12-month period, let's say you rented the property out for 200 days, all right? So 10% of 200 would be what? Would be 20, right? So you could use the property for 20 days personal use rather than the 14, all right? If that property meets those guidelines, it qualifies as investment property and you can use it in a 1031 exchange, right? Now, if it doesn't meet those guidelines, you know, I don't know, I wouldn't necessarily say it would be disqualified. In that case, I would recommend to the client and say, look, talk to your CPA. And if you and your CPA can come to an agreement where you feel like the property you can justify the property as being an investment property, then hey, by all means, use it in a 1031 exchange and sell the property, all right? You know, we're always going to recommend to people, talk to your CPA, all right? Because why? Because your CPA is going to have way more information than I ever would about your tax situation, all right? If the CPA comes back and says, yeah, I think we can justify it as being investment property, then you know what? We move forward with it, all right? All right, so 1031 exchange, vacation homes. I have a great PDF just on vacation homes, as I mentioned to y'all earlier. A lot of what we're talking about today I have in PDF form. All right, so let's talk a little bit about why is exchanging beneficial to realtors. I know we have a bunch of realtors on the line, and I always like to bring this up. You know, for one thing with 1031 exchange, there's always going to be two transactions, all right? There's always going to be what we refer to as the relinquished property, the property that's being sold in a 1031 exchange, right? And there's always going to be a replacement property, the property being purchased in a 1031 exchange, all right? So what does that mean for you as a realtor? Two transactions, two commissions, right? All right. Another aspect of 1031 exchange is the replacement property, all right? The property that's being purchased in a 1031 exchange. That purchase price must be equal to or greater than whatever the sales price was of the property that was sold, the relinquished property, all right? So what does that mean for you as a realtor? That means the commission that you make on the replacement property, all right, is going to be as good, if not better, than what it was on the property that was sold, the relinquished property, all right? The 1031 tax savings benefit. So think about this for a minute. If you have a client that is sitting there thinking they're going to have to cut this huge bill, this huge check to the IRS for taxes, right? What, capital gains taxes, depreciation recapture tax, Medicare tax, possible state income tax. Well, if you're the one that brings it to the table and you say, hey, you don't need to cut that check, right? You can do a 1031 exchange and defer all of those taxes, right? Now, that's just going to give them that much more to be able to go out and buy a better income, a better property, right? But hopefully it's going to be a better income producing property, but also hopefully it's going to be a better dollar property, a higher value property, right? So what is that going to do for you as a realtor? Well, for one thing, it's going to make you look great to the client, right? Because you're going to now they don't have to cut the check to the government. They don't have to cut the check for the taxes, and also it's going to hopefully increase your commissions because now they can go out and buy a better property, hopefully at the higher dollar property, which is going to result in you having a higher commission. All right, so the 1031 tax savings benefit. Sometimes we see this. Sometimes the property that's being purchased in a 1031 exchange, okay, the replacement property, sometimes that seller of that property is also an investor, all right? But maybe they don't know anything about 1031 exchange, right? So again, if you're the one that brings it to their attention, I don't know, who knows, maybe you can pick up another transaction and help them find some replacement property, right? Now y'all think about this for a minute. Any property out there that is non-owner occupied, all right, is a potential 1031 exchange candidate. Why? Because if they don't live in the property, they might be holding it for investment, right? Then those databases that you guys can tap into to get those kind of leads, right? There's one that I know of. It's referred to as List Source, okay? It's actually a product of CoreLogic. You probably have heard of CoreLogic. They're a huge data company, right? Now within List Source, you can do searches by zip code, geographical area, subdivision, and so on, right? And what List Source will give you, the results it'll give you the mailing address and it'll give you the property address, okay? Now, if those two addresses are different, you know they don't live in the property, okay? You could target the mailing address to the actual owner of the property, right? Because, we see this all the time. Somebody will own a property. Let's say they own a rental property, right? And they've owned that thing for years, right? And they know if they ever sell it, they're going to be looking at a huge gain and they're going to have to cut a check to the government. And you know what? They just don't want to cut that check. All right, so what do? They just hold on to the property, not knowing that they have any other options. Okay, but if you're the one that brings it to their attention, you target that mailing address, you target that owner of the property, and you say, hey, you do have an option. You can do a 1031 exchange, defer all your taxes. Now let's go out and find you something better, right? Who knows? They might be able to go from one property and pick up two properties, all right? Instead of having one income coming every month from one tenant, they can pick up two properties. They have two incomes coming in from two different tenants. That way they're not so reliant on just that one income, that one tenant, all right? So you can target the mailing address to the property owner, all right? And then you could even target the property address, all right? Because if they have a tenant in the property, who knows, maybe the tenant is actually looking to buy something, right? They might be looking to buy the property that they've lived in for all those years, but what? The owner was never willing to sell it to them, all right? So List Source. Now, other people tell me, other databases you can use within your MLS system. People tell me there's something that's referred to as IMAPs. Now, within IMAPs, I'm told, you can actually do searches by absentee owners, all right? Also, depending on the county, the property appraiser's office, some property appraiser's offices let you do searches by absentee owners, right? Those absentee owners, they don't live in the properties, right? They might be holding them for investment, right? So, if you've always said, well, I'd really love to get in with investors, maybe this becomes a way you can, a niche, a tool that you can use. 1031 is a tool that you can use to go out and target those investments, target those absentee owners, all right? People that don't live in their properties. If you're looking for a way to try to increase your business, maybe this is a solution for you, all right? So just some things to think about, right? All right, now let's talk a little bit about the 1031 exchange guidelines. All right, the basic requirements, the property qualifications, the tax deferral requirements. There's some timelines everybody needs to be aware of, and also there's some identification rules. All right, so the property qualification. So with 1031 exchange, again, you can do a 1031 exchange on real property held for productive use in a trade or business or for investment, and you can exchange it for what? Like-kind property, right? What's like-kind property again? Any type of real property that you use in your trade or business or you hold for investment, You can exchange it for any other type of like-kind property that you use in your trade or business or you hold for investment, all right? And what? The property can be anywhere domestically located in the United States, including Guam or the U.S. Virgin Islands, all right? What's not included? Puerto Rico, right? Okay, so let's talk about what property is excluded from 1031 exchange. What can you not do? What type of property can you not do 1031 exchanges on? All right, well, your primary residence, okay? You can't do a 1031 exchange on your primary because you have to hold the property for investment, all right? For your primary, you may qualify for what they refer to as a Section 121, all right? The way the 121 works is basically you had to have lived in the property for at least 2 years as your primary, all right? And when you sell the property, if you have any gain, if you're single, the first $250,000 of any gain is tax exempt. If you're married, the first $500,000 of any gain is tax exempt. That's referred to as a Section 121, all right? But you can't do a 1031 exchange on your primary. All right, property held for sale is also excluded from 1031 exchange. Give you guys an example. Let's say I own let's say I'm a builder, okay? Now, in the state of Florida, we have a lot of these like national home builders like Pulte Homes, KB Homes, I don't know, Lennar Homes, right? Like Pulte Homes, right? Well, Pulte Homes, they're one of the largest single-family residential home builders in the entire country, right? They build properties all over the country, all over the place, right? Well, the properties that they build, those newly constructed properties, what do they do when they finish them? Well, they turn around and sell them, right? Because they're holding those properties for sale and they're not holding them for investment, they can't do 1031 exchanges on those types of properties, all right? Dealer property is excluded. What is a dealer property? Well, dealer property may be somebody that we refer to as a flipper, all right? You know, they buy a property, I don't know, 2 or 3 months goes by, they fix it up, and what do? Well, they turn around and sell it, right? Well, they can't do 1031 exchanges on those types of properties because that's like their business. That's their inventory. You know, that's the business they're in. They're fixing properties up and they're turning around and selling them, all right? They're holding those properties for sale. You can't do 1031 exchanges on those types of properties, all right? Now, what if I'm a flipper and let's say 2 or 3 months goes by, I fix a property up, and instead of turning around and selling it, let's say you're their realtor, right? They come to you and say, hey, can you put this in MLS and let's show it for rent, all right? Let's put it for a fair market value rent. Well, that's a little different, right? Because now all of a sudden they're making their case where they're showing their intent is to hold the property for investment and not for sale, all right? So again, if that flipper gets audited, does a 1031 exchange and gets audited, and the IRS comes in and says, hey, prove to us you held that property for investment. Well, they have to be able to back it up, right? You know, they could easily back it up and say, look, here's the day I sent an email to my realtor saying to put it in MLS for rent. Here's the day it went into MLS. Here's the MLS listing. Who knows? Maybe they've even shown it to a potential renter, but they run a credit report, credit check on them. They have horrible credit. And you know what? They never rent it to them, all right? They got to be able to show that they were holding it for investment, be able to prove it if they're ever audited, all right? But if they strictly just turn around, fix it up and sell it, can't do a 1031 exchange on it. All right, so foreign property, this might be pretty obvious, but I couldn't sell a property here, let's say in Florida, in a 1031 exchange, and try to buy replacement property in Canada or Mexico or somewhere in Europe, okay? It has to be what? Domestically located property anywhere in the United States, including Guam or the U.S. Virgin Islands, all right? Again, Puerto Rico is not included in that number, all right? But foreign property is excluded. All right, so guideline number 2, the tax deferral requirements. All right, so rule number 1 is you have to reinvest all of the net proceeds in property of equal or greater value. All right, now, what are the net proceeds? Well, the net proceeds, that's the cash, all right? That's the cash that normally you would get out of the closing, all right? Now, we're the qualified intermediary, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, all right? Because again, as I mentioned earlier, the seller can never actually have receipt of those funds, the exchanger, all right? If they do, they would lose their ability to do a 1031 exchange, all right? So they couldn't close today and call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late, all right, because they already have receipt of the funds. They've lost their ability to do a 1031. They couldn't even close today. Get in the parking lot and call me from the parking lot of the escrow company or the attorney's office, because that attorney or escrow company or title company, they may be waiting to wire the funds out to them. Well, they would still lose their ability to do a 1031 exchange, because at that point they have what's referred to as constructive receipt. They have a legal right to the funds. They lose their ability to do a 1031. All right. So again, we hold the proceeds on their behalf. All right. Now they have to take that entire amount and they have to go and buy a replacement property equal to or greater than whatever the sales price was of the property that they sold. Okay. So take the entire net proceeds and buy a property, or it could even be a combination of properties equal to or greater than whatever you sold. All right. So with 1031 exchange, you don't have to just sell one property and buy one. You can do that, but you could sell one. You can buy multiple properties. All right. You could even sell multiple properties in a 1031 exchange and buy a single property or buy multiple properties. It doesn't matter. What matters, again, as long as what you're selling you're using in your trade or business or you're holding it for investment, and as long as what you're buying you're using in your trade or business or you're holding for investment. All right. So that's rule number one. Now, rule number two is you must acquire an equal amount or greater debt. What exactly does that mean, right? What that means is if you have a loan that you're paying off, all right, when you sell on the relinquished property, the property that you're selling, well, you need to get a loan of at least that amount or greater in any replacement property or properties, okay? Now, that rule can actually have an exception. If you happen to have cash that you can add to the closing of the replacement property, you can offset of having to acquire any additional debt, all right? Obviously, if you have no debt, if you don't have a loan that you're paying off in the relinquished property, well, you're not required to get a loan in the replacement property, all right? But you do have the option if you need to, okay? You can get a loan to help you buy the replacement property if you need to, all right? So those are rules. Reinvest all the net proceeds in property of equal or greater value and acquire an equal amount of greater debt, all right? Now, let's talk a little bit about guideline number 3. So some timelines everybody needs to be aware of, all right? From when you sell your relinquished property, all right, you're going to have 180 calendar days to purchase any replacement property or properties. Now that's calendar days, that's holidays, that's weekends, okay? Hey, those of y'all on the line that live in Florida, we're always subject to hurricanes, right? If we get hit with a hurricane and everything shuts down for a day or two or a week, whatever it may be, it does not matter. That clock is still ticking, all right? So it's 180 days to close, all right? Now, the first 45 of the 180, first 45 days of the 180, well, that's referred to as the identification period, okay? Now, what exactly does that mean? What that means is you must identify any potential property or properties that you want to acquire within the first 45 days, okay? That's something else that we're going to assist with, right? We're going to provide a form. It's called the identification ID letter, right? And on that form, it's going to have to be specific to a property address or addresses, okay? If they're buying a vacant land and there is no address, there's only a legal description, well, we need that, all right? That's going to have to be completed, signed off on, and it has to be submitted back to us by midnight of the 45th day, okay? That's how you formally identify replacement property, all right? Those properties don't even need to be under contract, all right? You just have to identify any potential properties. But here's the catch. If you happen to find the perfect property on day 46, okay, it's too late, all right? So whatever you put down on that form, you better make sure you're going to be able to buy at least one of them, okay? Because, again, after midnight of the 45th day, there is no exceptions, all right? There is no exceptions to adding additional properties, taking those properties off, okay? So what we generally see is somebody will put a property under contract because that's the best way to lock up a property, right? is to put a property under contract, right? And then maybe identify, I don't know, 2 other properties. And that way, just in case after the 45th day, if that contract happens to fall apart, at least they have the option to buy 2 other properties. Okay, so again, total of 180 days to close, all right? But the first 45 days of the 180 is called the identification period. Why is the identification, the 45 days, a good for you guys in the line that's a realtor? Well, for one thing, your client, they need to make a decision in 45 days, right? You're not going to be spending weeks and months on end showing them property. They have to make a decision in 45 days on what they potentially want to buy. All right. Sometimes this happens. Somebody will call me and then say, well, Jeff, I'm supposed to be closing on Monday. Now, I'd love to do a 1031 exchange because I have a huge capital gains. And I've been kind of looking for property, but you know what? I just don't know if I'm going to be able to find that perfect property because I'm already looking. I really haven't found anything. And I'll tell them this. I say, well, look, if you close on Monday and then you call me Tuesday, it's going to be too late. All right. You can't do a 1031 exchange at that point because you would have already have receipt of the funds. So I wait to talk about our fee until the very end, but we only charge $750 on the sale. All right. We don't collect anything until it actually closes. All right. Like realtors, they only collect earn their commissions when it closes. Well, we only earn our fee when it closes as well. All right. So we charge $750 on the sale, and then we charge another $200 on the purchase of the replacement property. All right. We don't charge any kind of cancellation fees or anything like that, junk fees, wiring fees. All right. So I'll tell them this. I'll say, look, we can set everything up for you for Monday. On Monday, we're going to charge you $750, but at least it's going to buy you another 45 days to try to get it all figured out. Because what happens is, by midnight of the 45th day, if you don't identify any properties, well, then you're going to be paying the taxes. All right, on day 46, we're going to refund you the funds that we're holding, and you're going to be paying the taxes. All right. So for most people, it's kind of like, well, what they're looking at having to pay in taxes, if they can pay $750 and give themselves another 45 days, usually it's a pretty good deal because who knows, maybe that perfect property does materialize in that 45-day period and they can complete their exchange. All right. But if not, the only thing they're out from us would be $750 that we would have collected the day of closing of the relinquished property. All right. All right, so let's talk a little bit about guideline number 4. There's some actual rules to identifying, okay? There's 3 different identification rules, all right? I'm going to go through each one of them, and I'm also going to give you all examples of how the numbers work. So when I initially read you the definitions, if you don't understand them, don't worry about it. Hopefully, once we cover the numbers, then you'll understand, how they work, all right? So the first rule, and this is probably the most popular rule, probably 90 to 95% of all the exchanges that we do fall under this first rule, all right? It's referred to as the 3-property rule. All right, and the 3-property rule states that you can identify up to 3 properties, all right, without regard to the fair market value of those 3 properties. So what exactly does that mean? Well, if you identify 3 properties or less, okay, the purchase prices of any of those properties that you've identified can be any dollar amount, all right? It does not matter as long as it's 3 properties or less, all right? Now, if you want to identify more than 3 properties, you can do that, all right? But you're going to fall into the next rule. It's referred to as the 200% rule, all right? And what that states is you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean, right? Well, if you identify more than 3 properties, okay, the combined purchase prices of all those properties that you've identified cannot exceed 200% or 2 times whatever the sales price was of the property that you sold, the relinquished property, all right? Again, I'm going to show you how the numbers work, so if that you don't understand that, don't worry about it. When I show you the numbers, hopefully you'll understand. All right, now, if you want to exceed this 3-property rule and you also want to exceed this 200% rule, you can do that, all right? But you're going to fall into this next rule. It's referred to as the 95% rule. Now, the 95% rule doesn't make a lot of sense, all right? But just remember, everybody, this is the IRS, all right? And sometimes this stuff just doesn't make sense, okay? Because it's really kind of a crazy rule the way it's written. Let me read the rule to you, all right? So it's when you the 95% rule states that you can identify over 3 properties and you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. Again, I know that doesn't make a lot of sense. It's probably about as clear as mud, all right? Let me show you all the examples, and hopefully everything will click for you, all right? So here's the 3 property rule, all right? 3 property rule is, again, if you identify 3 properties or less, they can be any dollar value, all right? So here we go. We sell for $1 million, all right? And then we go out and we identify 3 properties, all right? So we identified 3, we're in the 3 property rule. Now let's just say we're going to be buying each one of those for $1 million, right? So we've identified $3 million worth of property. Now we could be buying each one of those properties for, I don't know, $10 million a piece, all right? For a total of $30 million. Again, if it's 3 properties or less, it doesn't matter. They can be any dollar value, right? It doesn't matter. Again, what does matter? Well, I'll say it again. If you identify 3 properties, you better make sure you're going to be able to buy at least one of them. Because again, if it's after that 45th day and one of them burns down to the ground, all right, we get hit with a hurricane and one of them gets destroyed in a hurricane, you are locked in to only be able to buy that one other property, all right? So what's, again, the best way to lock up a property is to put one of them under contract. And again, that's what we typically see, is somebody will put one property under contract, and then maybe they'll identify 2 additional properties. All right, so that's the 3 property rule. Now, here's the 200% rule. All right, this is when you identify more than 3 properties, but then you cannot exceed 200% or 2 times the combined fair market value of the property being sold. All right, so let's say we sell again for $1 million, but now we go out and we identify 5 properties. Okay, because we've identified 5 properties, we've exceeded our 3 property rule, right? So that puts us into the 200% rule. So what that means is the combined purchase prices of all 5 of those properties that we've identified cannot exceed $2 million. Now, where is the $2 million coming from, right? Well, we sold for $1 million, right? 200% of $1 million that we sold, or 2 times $1 million that we sold, is $2 million, all right? So that's where the $2 million is coming from. That's the 200% rule. All right. Now, here's the 95% rule. All right. Now, again, this is where you identify more than 3 properties and you actually exceed the 200% rule. All right. But you must acquire at least 95% of the value of all the properties that you've identified. All right. So here's how it works. Okay. We sell for $1 million again. Now we go out and we identify 10 properties. All right. Because we've identified 10, we've exceeded our 200% rule. Right. I mean, our three property rule. All right, because we've identified 10. Now, let's just say, we'll keep the math really simple. Let's say we're going to buy each one of them for $1 million, all right? So we've identified how much? $10 million worth of property. Because we've identified $10 million worth of property, we've exceeded our 200% rule, right? Because what was that number? That was $2 million, right? So that puts us into this 95% rule, right? Now, in our example, if we only acquire 9 out of the 10 properties, that's only 90%, or $9 million, right? That's not 95%. Okay, if we do that, if we only acquire 9 out of the 10 properties, we actually blow our entire exchange and we have to pay all of the taxes. All right. So the reality of the 95% rule is really 100%. All right. Of whatever you identify, you're going to have to buy. And we're using really simple math too. We're saying everything's going to be an even $1 million a piece, right? The reality of it is those purchase prices are going to be all over the map, right? It's going to be really hard to sit down and say, okay, let's see, if I get this property, wait, that's only 93%. All right, maybe I need to get this other property. Oh, that's only 94%, all right? 95% rule is really 100% of whatever you identify, you're going to have to buy. All right. The IRS wants to limit you and how many properties you identify. All right, they don't want you identifying everything under the sun, because you know what? If you do identify everything under the sun, you're going to have to buy everything under the sun because of this crazy 95% rule. All right, so and it's rare that we even see this rule enacted. Mostly, like I said, the 3 property rule is really what we see generally, probably 90 to 95% of all the exchanges that we do. But I just want everybody to realize there's 3 rules and not just 1 or 2. There's this last one, which is really kind of crazy. All right. So let's talk a little bit about how the whole process works, right? Excuse me. So we really start doing our thing once a contract gets signed for the relinquished property, the property that's being sold. Because what happens is I need to get a copy of that contract. And I also need to get information on who's going to be handling the closing, right? Because what happens is we reach out to that company or attorney's office, whatever it may be, whoever it may be, and we get a copy of the title search, the title commitment, all right? And once we get the commitment in the contract, we turn around and we prepare what we refer to as the exchange agreement, all right? And what the exchange agreement is, it's basically documents that set the exchange up, all right? Those documents will be signed at the closing of the relinquished property, all right? Because what happens in that transaction is we step into the shoes of the seller, right? And that's the way we're able to take those proceeds, whoever's handling the closing, they wire those proceeds over to us, and we hold those on behalf of the seller, the exchanger, right? So that transaction happens, and then the clock starts ticking, right? 180 days to close, 45 days to identify. We're sending out the identification letter. The exchanger's getting it back to us by midnight of the 45th day. Once they get a contract on the replacement property, we need to get a copy of that contract as well. All right. We also need to find out who's handling the closing on that transaction, all right? Because why? We're holding all their proceeds, all right? We need to get wiring instructions. We need a contact person who we're going to be dealing with, because we're going to actually prepare some additional documents that get signed at the purchase of the replacement property, all right? Because in that transaction, we step into the shoes of the buyer, and that's the way we're able to take those proceeds, wire those proceeds over to whoever's handling the closing, and to help them buy that replacement property, all right? That's the entire process. It's a pretty simple process. Just, everything leading up to it is the complicated stuff, all right? Once we get to the actual closings of the transactions, that's the really easy stuff, all right? So as far as the way title gets transferred in either transaction, like a typical closing, it goes from the seller to the buyer in each transaction, all right? Now, we are just about out of time. Let's talk a little bit about our fees, all right? So I already mentioned the first one. The most common type of exchange, and everything we've talked about today is referred to as a delayed exchange, right? Probably 90 to 95% of all the exchanges that we do are delayed exchanges, all right? That's actually where you sell first, so you're selling your relinquished property, and then within 180 days, you're purchasing your replacement property, all right? That's called a delayed exchange. Again, our fee to do that is we charge $750 on the sale, all right? And then we charge $200 on the purchase of the replacement property. So basically, if you sell one property and you buy one property, a total fee is $950, all right? Again, we don't collect anything until they physically close. So we don't charge any kind of cancellation fees, wiring fees, that type of stuff. All right, the $200 isn't collected until the replacement property is actually at closing. Now, if you buy a second property, it's another $200. All right, so that's a delayed exchange. Now, there's a few other types of exchanges. We're not going to go into them in great detail today, but there's one that's referred to as a reverse exchange. It works just the opposite of a delayed exchange. It's actually where you buy first. You buy the replacement property first, and then you sell your relinquished property last, all right? Those start off at about $6,500, all right? They can be significantly more complicated. We have to form a separate company. We form an LLC. We buy the replacement property. We go on title. okay? But that's referred to as a reverse exchange. They start off at about $6,500. There's another type of exchange referred to as a construction. Another term you may hear of it is referred to as an improvement exchange or built-to-suit exchange. Those can be extremely complicated too. It's actually where you sell your relinquished property, and then we come in and buy the replacement property and oversee any improvements that you want to be completed in the property. We form a separate company to do that as well. We work with the contractors, all that type of stuff. Those start off at about $6,500. Today's class is just a basics class. If y'all are interested in learning about the reverses in construction, I have another class next Tuesday, December 10th. It's going to be from 11 to 12 Eastern time. It's an advanced class. We talk about the various types of exchanges in more details. We talk about LLCs, entities, foreign persons, related parties. We talk about more about the numbers of how to calculate what your gain is. If y'all are interested in attending that, feel free to register for that class as well. To give you a little bit more in-depth knowledge of 1031 exchange. And again, we're going to talk more specifically, more details about the reverse exchanges and the construction and improvement exchanges in that class. All right, so we are just about out of time. I'll open the floor up to questions now. There's a box again on the right-hand side for questions. While we're waiting for the questions to come in, I'll just mention to you guys, for those of y'all that are on the line that are realtors, I actually have a 2-hour continuing ed class approved with the for Florida realtors to get 2 hours of continuing ed. I do that class a lot for in-house classes for real estate offices, boards of realtors. If you're interested in bringing me into your office, I'd be glad to come in and teach that 2-hour continuing ed class to the realtors in your office to get the 2 hours. Again, I cover the entire state of Florida, so I'm pretty much go anywhere in the state of Florida to do that class. I also do this class too as well, this 1-hour basics workshop. I mentioned to y'all I have an advanced 1-hour workshop as well. I'll do those in-house as well. If you want me to bring me into your real estate office, board of realtors, title companies, attorneys' offices, CPA offices, just let me know. My contact information's up on the screen. And I'll mention this again too. A lot of what we talked about today I have in PDF form. If you'd like to have those PDFs emailed over to you, just let me know. Send me an email or you can give me a call. If you have clients that have potential 1031 exchange needs, hey, feel free to forward them on to me. I'd be glad to talk to them, or if you individually have questions or needs for 1031, let me know that as well. I'd be glad to talk to you. I talk to people all day long about 1031 exchange. All right. Well, it doesn't look like any questions are coming in, so we must have did a pretty good job explaining everything to you guys today. But, if after we hang up, you do have a question, just feel free to shoot me an email or give me a call. I'd be glad to talk to you. And then again, for those of y'all that would like to join in the advanced class, it is going to be next Tuesday, December 10th. We're going to do it from 11 to 12 Eastern time. If you receive the registration information on today's class, you should have also received the registration information for next week's class, next Tuesday's class. If not, just let me know. I can shoot you the registration information, and if you'd like to join in, great. But again, today you're going to receive today's audio and video recording, a link to listen to the class again if you'd like to. All right, well, we're going to go ahead and wrap it up. I appreciate everybody joining in today. Hopefully you learned a little something, and if I can do anything for you in the future, please let me know. And if you can join in next week, do that as well. But happy holidays to everybody. Y'all have a great day. Thank you. Bye-bye.